This is a brief overview of the process of Swiftly Financial. The core mission of any financial advisor, wealth manager, etc. should be to manage risk. The truth of the matter is, due to money supply expansion and economic growth, we should expect that over time, equities or stocks will rise in value. Let's say that's the easy part. It's the risk management piece that is difficult and is where investors can gain an edge. Most investors think of equities when they think of investing and when they think of risk in investing. However, there is risk in no matter your choice of financial assets. If you choose cash, you have a relatively high level of inflation risk. If you own bonds, you're taking interest rate risk, which is tied to inflation risk. And in some cases, you can be taking on credit risk and so on. While there is no perfect prescription for how to manage risk, understanding how markets and investors overall are addressing risk can provide a helpful framework. Here are 3 charts worth monitoring on a consistent basis, which help to provide a framework for risk. They are the equal-weighted consumer discretionary stocks versus consumer staples, the transports versus the utilities, and finally the U.S. Treasury yield curve. All are insufficient on their own, but provide context for risk. Another way to manage risk is to consider what the companies themselves are doing within a given sector. There is no perfect formula to manage risk, but allocating capital to companies that can execute in markets improving relative to expectations can be a nice formula to generate above market returns. Again, there are no guaranteed formulas for outperformance. However, there are processes that can generate some very impressive returns.